Hello and welcome to the Benzinga podcast. Hello and welcome to the Benzinga podcast. We've got another great episode for you today. We have a conversation between Benzinga and Dan Niles from Alpha One Capital Partners. There he is a co-chief investment officer where he manages a concentrated multi-sector long-short equity fund. We're going to go right into the conversation. Thank you very much for listening.
Hi, welcome to Benzinga's podcast. Today we have Dan Niles, Co-Chief Investment Officer at Alpha One Capital Partners. Hi, Dan. How are you doing today?
I'm doing well. How are you?
Very good. First of all, I'd like to thank you for coming on and talking to us. I know you have a lot of insight to offer our readers. We saw you on Fast Money the other day, and you were bearish on the semiconductor space and on, some of the macro trends in general, and we just kind of wanted to pick your brain a little bit about that. Could you outline your thesis on semiconductors and then maybe just talk a little bit about macro trends in general and what your outlook is on the near to medium term?
Sure. I think what I'll do is I'll actually reverse the questions because it's really the macro that's driving into semiconductors, and semiconductors are a very ramped-up reflection of whatever is going on in the macro. So if the macro is getting worse, semiconductors will absolutely collapse. If it's getting better, they'll absolutely explode to the upside. So, let me start with the macro picture. I think the way I think about it on a big picture basis is where we are today is sort of culmination of things we've gone through since the late 90s. And what I mean by that is the following. If you go back to 98, you had the currency crisis, the Asian currency crisis. So the Fed cut rates, and what that enabled companies to do, specifically in the telecom area, was go out and take out a lot of debt. So you had companies taking out over $10 billion in debt, then promptly go bankrupt. And when the tech bubble burst, as you may remember in 2000, the Fed then went ahead and cut rates again, because if you had that much spending, going away from companies like Global Crossing, for example, that no longer existed, the economy was going to have a pretty hard landing. So what happened was when they cut rates, they encouraged homeowners to go out and buy houses, and as that kind of rolled, that took care of the issues in the telecom sector, and that the consumers now took on all that debt. When consumers ran out of the ability to borrow and had their own issues with the credit markets and the housing market rolled over, then what governments did was they said, if the consumers can't borrow and all that spending goes away, we're going to have a really big problem. So governments around the globe said, well, you know what, we'll take on that debt that they had onto our balance sheets, and we'll spend money that we don't have and run up huge debts. The issue today is, as you've seen with a lot of the headlines out of Europe, as governments have run out of the ability to borrow money, who's going to take on their debt? The answer is there's nobody. That the government is sort of the last resort. So the issue today is, unlike for the past year, where you had nothing but stimulus pumped into the global economies, now you're having the capital markets enforce discipline on governments who spent money they don't have, much like they did with telecom companies like Global Crossing back in the 2000 period, much like they did to consumers who shouldn't have been buying homes, and now they're doing it to governments that are spending money that they don't have. Now, the reason why I think it's important is if you look at the size of some of these countries individually, they may not seem that big. For example, If you look at, Portugal, it's 37th largest country in terms of GDP. Ireland's number 38. Greece is number 28. If you look at the pigs in total, which is Portugal, Italy, Ireland, Greece, and Spain, they make up about 7.6% of global GDP. China, to put it in perspective, is about 8.6%. So they're not that far behind, and it would put the pigs in total, if they were a country, at number 4. If you look at the European Union put all together, so the 16 countries that make that up, they're 28% of global GDP. And the U.S., for example, is about 25%. So if Europe, in fact, now has gone from spending money they don't have to boost up their economic buying power,
right,
to now they're implementing austerity measures, and on top of it, the cost for them to borrow money has gone up, that's an awful big weight you're going to have to deal with. And obviously in the U.S., it's bringing up some questions of how long are we going to be able to spend $1.5 trillion a year that we don't have. So that's really the issue from a big picture macro basis. Now, you asked the second part of your question was, well, what do I think of semiconductors? Well, if you are going through a phase in time where spending is being cut back on, IT spending is very correlated to GDP growth. So if you're seeing that start to come back, it's natural to expect that you might start to see some signs of slowing. Now, on the retail side, as you know, roughly 70% of U.S. GDP is made up of consumer spending. And the good news is we had Best Buy come out and report numbers recently. And to put it in perspective, Best Buy did about $11 billion of revenue in the May quarter. So they're a fairly large company, I think we'd all agree. The issue is when you look at their numbers, out of the 5 segments that they have, 4 out of those 5 segments decelerated from February year over year to May year over year. And within that, I think what we're focused on here is the electronics category, because that's the big driver of semiconductor demand. In November of 2009, year over year, it grew 8%. In February this year, it grew 4% year over year. And in May, it was dead flat. And in addition to that, if you look at their inventories, their days of inventories were at 71 days, which is the highest in 7 years. And so, that didn't go well either, which in my mind speaks to the fact that business probably slowed as the quarter went, and they talked about it would take them the rest of the year to probably work that off. So if you then go one step deeper and you go, well, how do you build consumer electronics devices, whether it's PCs or handsets, etc.? Well, and as an aside, we are short Best Buy, so just to be clear.
Okay.
The way you build it is with semiconductors. And so you have to sit back and say, okay, well, Best Buy obviously had some issues. Nokia pre-announced, which is the largest cell phone manufacturer in the world, a couple of days ago. This is giving you a real-time read in terms of what, in fact, is going on with demand. Now, at the same time, you've got all the semiconductor companies, for the most part, saying demand is great, it's never been better, we're feeling very good about business, etc. And, the problem is that semiconductor companies, in a lot of ways, are the last companies to see it. Because what will happen is Best Buy maybe doesn't get to sell, cell phones, etc. A company that sells cell phones, let's say, then has an issue of their own. And then they sit down and say, we might have a problem. Well, you know what, we don't need as many chips as we originally thought to put, because we don't need to build that many phones because we're not selling the ones we currently have. So it's a food chain effect, and so it always takes the semiconductor companies, a lot longer to see these issues. And I think, it's a very long-winded answer to your question, but I think you have to really, link the food chain all the way from what's going on in Europe and debt, all the way down to, end demand at Best Buy or Nokia, all the way down to what potentially the semiconductor companies are going to see 3 to 6 months from now.